Good morning, everybody. Welcome to this morning's webinar with Sam Smith from the Intervale Center on understanding farm financials. I'm Eric Derby with the Food Shed Alliance. The Food Shed Alliance works to help farmers feed people and protect the environment. And one of the ways we help farmers is to help them access farmland through our Sustainable Agriculture Enterprise Program, SAGE. That land access program helps provide 10-year leases to farmers who can provide a strong business plan and agree to grow organically. That program, when it launched, we quickly learned that providing land access certainly is a challenge, but it doesn't end there. We know that protecting the viability of the farmer's future is so important, and understanding farm financials and business planning is an integral part of the success of your future on your farms. So with that, I want to turn this over to Sam, who does this work every day, helping farmers protect their viability and grow their future, and inspires us to continue doing this work and emulate some of the things that they're doing at Intervale Center in Vermont. Hi, Sam.
Hi, Eric. Thank you. I'm going to just pull up my PowerPoint and we'll jump right into it.
Great.
Go. All right. Eric, can you just let me know if that showed up for everyone? Great.
Yeah, I see it really, really good.
Okay, great. Yeah, so for those of you that weren't on my presentation the last time around business planning, my name is Sam Smith. I am the Farm Business Director at the Intervale Center, located in Burlington, Vermont. We're sort of in the center of the map there, just south of Montreal and on the shores of the beautiful Lake Champlain. The Intervale Center is a land-based nonprofit. We manage about 350 acres on unceded Abenaki land. We are a nonprofit devoted to supporting farms, land, and people. So we have a number of different programs. I run a farm business support program where we do direct one-on-one technical assistance with farmers, teaching them business management skills and helping achieve their long-term goals. We also have a conservation nursery and a food distribution center that is based around food access, and we do a lot of public engagement. We also lease land to, at this point, I think we have 6 farmers. We ran an incubation program for about 15 years, and a number of our core farms expanded into the land that we used to use for the incubator. So yeah, we primarily support farmers across the spectrum in terms of the types of farms we work with, in terms of the types of crops they grow, the stage of business that they're in, and just, yeah, a wide range of farms. So today we're going to focus on farm financials. Tess was kind enough to send along some questions that were sent in prior to this. And so given that there's probably a little bit of a range of experience and familiarity with farm financials on this call, I'm really going to focus on the fundamentals of farm financials. I think that even if folks have been in business for a number of years, it's really good to understand how to get, how to have financials structured properly and understand how different financial statements correspond. We'll talk about it a little bit, but this really is the financial piece. If you're not making money on your farm, then there's, you may have other goals, but the reality is that if you continually lose money through your farming venture, you're going to be out of business and you're not going to be doing it anymore. And most farmers really enjoy the process of production. They enjoy either working with animals or vegetables, with the soil. I have a little homestead, and I enjoy doing those things too. But if you're not doing it for profit, then it's probably best to really either adjust and build your management skills, or to really scale it down to a level that you're just doing it as a hobby. So today we're going to focus on the three primary core financial documents that are at the heart of, really any business. And so those are the profit and loss, or sometimes called the income statement, the cash flow, and the balance sheet. And if we have time at the end, we're going to talk a little bit about some other things that you could do in terms of like an enterprise analysis, cost of production, or return on investment. So we'll get into the specifics of each of those. What I will say is having that fundamental understanding of these three basic financial documents and structuring them correctly will allow you to do the analysis or interact with the financial system more broadly in a much more coherent way, and really being able to access capital, whether it's grants or loans, or just communicate with others around the finances of the business. So I put this up here because this is a really fancy farm just down the road from my house. And these folks that bought a converted dairy farm, or they bought an old dairy farm and converted it into this like massive estate property. Our house actually was a former labor housing for the dairy farm at one point. And I put this up because a tendency among farmers, just like anyone else out there in the world, is that we compare ourselves to the sort of external presentation of the others around us. And we make assumptions around their profitability or the way that they're running their business. And this particular business is competing with other local farmers near us, but the owners have basically an unlimited amount of capital. And so, to have other farmers look at this and say, well, yeah, they're making money. And these people, I can assure you, are definitely not making money and probably will never make money, but it doesn't really matter to them because they have some other goals and they have the capital to do that. So I would just say, your finances are personal to your business, and your goal should always be to strive for profitability and to identify what your financial goals are and try to meet those. But comparing yourself to other farmers just in terms of things like pricing or a perception of profitability is really unhelpful and counterproductive over time. You should know and understand your financials as deeply as possible, and then identify your own areas of success. So, if you attended the business planning one, you know this, but we are a very goals focused. We have a very goals focused process at the Intervale. We work with folks to identify their financial, personal, and business goals. So when we talk about financial goals, it's really about understanding not just the financials of the farm, but understanding how they interact with the holistic farm financial goals. So, we have folks do, and we'll talk about this in terms of structuring the financials, but we have folks integrate the things into their lives or from their lives into the financials to really understand what their full financial needs are and what those goals need to be. But on the most simple level, this chart here sort of conveys that, what we're going to look at, this would be a summary of a profit and loss or income statement where we have farm income, farm expense, we have the net farm income from operation, and then we layer in things like debt service and family living and off-farm income. If it's a partners and one of them has off-farm income, and we end up with this financial goal. So what they need to achieve their goals, say it's saving for retirement or being able to purchase a house. So and you can start on a really base level with this and then work your way up in terms of, as your business grows, your goals change. So I also want to just clarify the types of financial activities. We're going to be talking about each of these at some point during this presentation, but I wanted to clarify sort of when they happen and what they look like. So a lot of folks confuse bookkeeping and accounting. Bookkeeping is the sort of routine maintenance of your books. It's like entering your income, whether that's in the form of cash income, or it's going out in terms of invoices and people are paying through credit cards or through checks. And then the expenses would be likewise, like when you sit down, you take a lot of folks will have a business credit card. It's sort of a best practice to separate farm and personal finances. They'll take that credit card and they'll go through weekly and sort of look at that statement and say, well, this needs to go over to this account. This one needs to go to this account. So, and then we have the process of accounting, which is usually done by an external professional, where they do a quarterly reconciliation or annual reconciliation, and it usually corresponds with taxes. And, we'll talk about some of this, but a lot of times you want to try to have the bookkeeping and accounting services sort of align with the scale of the business. So some folks with a really large business may have a bookkeeper in-house. They may even have someone with accounting skills in-house. And then the last one of these is financial analysis. And that is taking those records, those financial records that you create through your business operations, and using them to analyze the performance of the business, to get you information around things like cost of production for specific crops or something like that. So we'll go through these. So bookkeeping, bookkeeping, when I was talking about the different level of bookkeeping as it relates to the scale of the business, we work with people, and what we really try to do is move them along the spectrum. Most folks that we start working with are in that sort of 0 to 5 year period, and they may be in a shoebox with a bunch of receipts that they show up and bring to their tax accountant once a year, and or they may be in an Excel spreadsheet that they've developed or they've found somewhere. And our goal is ultimately to get them into a bookkeeping software, something like QuickBooks or Xero. And that definitely takes time, and it's also it's good based on the scale of the business. If you're doing $10,000 to $15,000 in gross sales, the shoebox and a handwritten receipt book may be just right for your business. If you're up at 75,000, 100,000, 200,000 in sales, unless you're running a really simple business where you sell all of your product wholesale in one shot or two shots twice a year, and you have relatively limited expenses, you're probably going to want to be in a bookkeeping software system. And it's worthwhile to find someone and pay someone to help you set it up and potentially train you to do that, or even pay them to do the bookkeeping on a weekly or monthly basis. I have a lot of, we actually provide services in-house for the farmers that we work with here in Vermont, where a couple of the business planners that work with me are now QuickBooks trainers, and they will work with farmers. What we see oftentimes is that farmers dabble in QuickBooks and then they quickly realize that they either like it or they don't like it. And the ones that do like it stick with it, and it becomes a really useful tool for them. And the ones that don't like it, and by saying they don't like it, I mean they don't like doing the weekly or bi-weekly updating of the income and expenses, they may hire someone to do that because it's worth their time to be able to pay that person, $35, $50 an hour to do that bookkeeping work, so that they can go and focus on the farm and on trying to make money through growing and selling their products. It really does need to be done regularly. I have definitely worked with folks who get to the end of the year and then update their QuickBooks. And what you're losing when you do that is the capacity to be able to understand and adjust real time. The real value in understanding financials is that you should be able to get that information out relatively quickly and then make adjustments in real time. And a great example of this, I work with a vegetable farm. They started out really small. They were actually both working for another vegetable farmer who was a mid-scale vegetable farmer, and they started a side business growing wholesale peppers. We eventually helped them through the purchase process on a farm, and they call me every September and in a state of crisis because they don't have any money in their bank account now. And I think they're doing about $500,000 in sales. And I always tell them, well, have you updated your books? And they go back through and they'll update the QuickBooks, and they'll get back to me 3 weeks later and they'll be like, oh yeah, we're going to be totally fine. Yep, we had all these receivables out there and we just didn't know what our finances look like. And so really doing that routine maintenance is important. Accounting, we sort of talked about these. Once again, this has to be done in a timely manner, especially if you're doing things like paying quarterly self-employment taxes, or you have people on payroll and you need to be doing payroll. A lot of times that is definitely a service that folks outsource. It can be done in-house, but folks usually don't prefer to do that. So I do want to make a note on taxes. Tax avoidance seems to be a sport for farmers. It's the thing that they enjoy, only second to production of the crop, their chosen crop. And I will say this, if you are paying taxes, it means that you're making money. It also means that you will, be eligible for Social Security if that is still available when you retire. And it makes you eligible for things like getting a loan. If you don't show your income on your taxes, then someone like a lender won't be able to, even if you tell them about it, will not be able to confirm it through the fact that it's just not recognized by the government. And so taxes, while tax avoidance does have some immediate benefits, usually the long-term benefits of paying the taxes make it a better idea. So in terms of financial analysis, the one that we're going to talk about it later on in the presentation, but the cash flow is the most important financial document that you should have as a farmer. A monthly cash flow with income and expenses is the document that most dictates the financial success of your farm business. And I can't reinforce that more. We'll talk about the structure of that document and the things to look for a little bit later on. But I would say the majority of farmers that I've worked with in the past 10 years have, you know, if there's one thing that I've taught them, it's that you should have an active cash flow. You should develop it in the fall of the year before you are proposing to be in production. And then you should update it regularly with the actual performance of the business so that you can make adjustments. And it doesn't matter your scale. So we'll talk about that. Just annual performance of the business. So understanding things like what labor was as a percentage of gross sales, or if you're a vegetable farmer, you know, what your seed and crop inputs were as a percentage of gross sales. Changes to the farm business. So we often see folks making infrastructure improvements like a wash pack shed or installing a new cooler. And it's great to be able to understand how much that's going to cost and how much they hope to increase their business to be able to get a return on that investment. Enterprise analysis is a great one. It's sort of looking at a specific enterprise within a farm. Say if someone had layer chickens, like this guy in the picture here, you would want to break out the income and expenses related directly to that enterprise and see what it's contributing to the farm financials overall. And then just capital access and allocation. So if you're improving your infrastructure, buying equipment, or buying a property, you're going to have to understand how that's done and how the analysis is done to get there. This is just a note on cash versus accrual. We're going to be talking about cash accounting here. Accrual-based accounting is something that most farmers don't do. And it's primarily just based on the complexity and scale, but this is like the most baseline sort of chart about what the difference is there. But it has to do with when the timing of income and expense recognition within the financial system of the business. And I will say, if folks have any questions, feel free to pop them in the chat, and I should be able to see them and can address them in real time too. So we talked about each of these. The way the financial statements were explained to me by one of my mentors, who is a farm business planner, and who I put, his book is in the resources at the end of the presentation, is, you know, his name is Richard Wiswall, and he did this wonderful book on farm business development. He's a vegetable grower who has been really successful and profitable, and found a passion in teaching other farmers about farm business management. But the way he talked about it is the balance sheet is like a snapshot of your farm. If you were to fly over it on any given day and take a picture, it's a like photo in time of essentially what the assets of that farm are, what you own, and then the liabilities, which you wouldn't be able to see on the picture, but the things that you owe. The profit and loss is the income and expense for the period between those two balance sheets. So, and we'll talk about when the timing of the balance sheet and how you do it. But the profit and loss shows how much money you made and how much you spent and what's left over. So your gross income, your expense, and your net profit. And then the cash flow is this, it's a document conveying over time how much cash is available to that business. So you have income and expense, and then you have cash on hand at the bottom. And we'll talk about why that's important a little bit later on. I will say that it's important. One of the questions that came in was really talking about setting up your financials. And it is really important to have a good chart of accounts. So the chart of accounts are the accounts that you have within the business that talk about income, expenses, and equity. And so if you go into QuickBooks, they'll recommend that you're set up with a certain chart of accounts. You'll see some of the financials later on in this presentation. We have some resources on our website, which I have a link to at the end of the presentation as well. But what I can say about the chart of accounts is you want it to reflect your business. You want it to align with taxes. So getting a hold of a Schedule F is a good place. If you're going to start with anything, it's probably starting with the Schedule F. Has just basic categories that you would want to put your expenses and income into. And it can shift over time, but one of the best things you can do is really clarify that chart of accounts early on in your business, and then try to be consistent about putting the income and expenses in those same accounts as you move forward, because that's the thing that allows you to do analysis later on. And I will say, I like to try to keep them relatively simple. So if your chart of accounts is like really long, you're going to end up with all these accounts with like, $50 in expense on an annual basis. And that's not really useful information. It's really, you want to try to keep the top line level things. I like a threshold of $500 on an annual basis as a good level for both income and expense accounts. And that allows you to sort of understand the top level financials. You're not going to need that little $25 or $50 detail to do the analysis overall. So the first thing we're going to talk about is the balance sheet. We could do any of these. I probably should have put the cash flow up top, but it's the most complicated document. And it's also the one that, it just takes some time to work through. I will state that I have worked with a number of farmers over the years, probably 400 or 500 in the last 10 years. And what I'll say is, I don't know if any of those folks were truly, they were enthusiastic about the numbers to start out. So I am also I'm not a numbers person. I have an MBA. I went back and got an MBA. But I don't really thoroughly enjoy being in spreadsheets all day. I see the reason that I really enjoy financials now, and I enjoy teaching about them, and I enjoy working with farmers, is that to understand the financials empowers you to be able to better manage your business and meet your goals. And I know that firsthand because it's worked for me in my personal life. My little homestead, even though it's not not a profitable farm business, I have my goals and I know my cost of production, and I know the scale that's right for me there. And I've just seen it time after time that if a farmer gets a good grasp of these financial statements and how to develop them for their farm, and then how to work through them on an annual basis, they ultimately can understand well in advance of, events, whether it's, something happening like COVID was a huge one, where a lot of the farmers that I worked with were able to really pivot quickly and make adjustments both on their expenses and income end to come out of that in a much better position, right? Whereas if they had not had those skills, they would have potentially, it could have been really disastrous for them. So we'll go back. The balance sheet is really simply, it's what you own and what you owe. And so if you look at this is a sample balance sheet, Total Loss Farm, which I think actually was the name of a commune in southern Vermont where I grew up back in the 70s, and I used it as my sample farm. So this is based on a real farm, and then it's been sort of anonymized. But basically, the balance sheet, it's sort of it helps you assess your net worth, or how much equity you have. That's that consolidated net worth line item down at the bottom there. We have, this particular form has both farm and personal assets and liabilities. And I will say that it's not common to have intermediate liabilities in any other business than farming. So, but farming has some specific needs. Most businesses just have current assets and then long-term assets. But farms, we like to break it out with some intermediate assets and liabilities. The balance sheet allows you to track growth or decline over time. So if that net worth is going up or down on an annual basis, that's an indication of success in your business. It allows you to access capital if you want to buy a piece of equipment, build an infrastructure, or get a farm loan. This is the one that most banks are going to look at first. And then it also allows you to provide a value for the business. And this becomes important if you ever want to sell your farm, or if you have a multi-member farm. I've worked with folks who have an LLC and they either got divorced or separated. And if you have a balance sheet that's relatively current, it makes it much easier to facilitate that separation. I put this in. So there's two different types of accounting. There's sort of tax accounting and the financial accounting that we like to do with farmers. And so we like to do a balance sheet based on fair market value. If you are doing it for tax purposes, you're going to have depreciation integrated into that balance sheet. So, but for the purposes of your understanding of your farm finances, what you really want to understand is the fair market value of the assets that you have on hand. And I put this picture up here because I really like folks to be realistic about the values that they're assigning to their assets. So if I pulled into this farm and then the farmer said, well, that truck over there is worth, $15,000. It actually may be worth $15,000 now. Pre-COVID, probably not. But what we like to do is have folks assign a real fair market value. And oftentimes I'll call that like the Craigslist or Facebook market book value, where if you were able to sell that to someone through those marketplaces on a local basis, what would you be able to sell it for? And that is the fair market value. And oftentimes I end up pushing back on folks who are like, this is worth, this tractor is worth 30,000 over here. And I'm like, well, it's split in half and sitting in your yard and it's covered in rust. So I'm going to have to say that that's probably not the case. Let's see what your neighbor would pay for it. And then we'll use that as the fair market value. So it's just a way of being realistic about your assets. If you were to go to a bank and try to get a loan, they're going to look at those assets and they actually apply a discount to their perceived value of the asset. So they may look at the tractor and say, well, that's only worth 15,000. And then I'm going to apply a discount of 10% because I know that that's what it would cost me to sell it if they're going to use that for collateral. I don't know why this is. Thank you, Microsoft, for suggesting that the skeleton is conservative. But anyway, I like them to be conservative, consistent, and complete, right? So you want to make sure you have everything on that balance sheet, both assets and liabilities. You want them to be consistently valued year over year. So you have to have a process for that. If you're doing it, then you should really think through how you're going to do it every year. And then having them be conservative. So not really, you just want to make sure that your values are realistic and aligned with those fair market values. So, those assets are broken into three separate areas. The assets and liabilities for our purposes, we have short-term, which would be things like crops or market livestock or cash on hand, or receivables if someone owes you money that you think they will actually pay you in the next 12 months. So short-term is usually anything that is related to the operations of the business in the next annual cycle, right? In the next calendar year, also called annual operating assets. Sometimes for farmers, we'll have like storage crops in there, or another good example. Intermediate assets are things like vehicles, equipment, temporary structures like hoop houses are a good one. And this is an interesting one for folks who do have vegetables. We oftentimes will separate out the frame of the hoop house and the plastic, because the plastic has a 3 to 5 year lifespan and the frame has like a 15 to 20 year lifespan. And then breeding livestock, so things that are going to be not, sold or slaughtered in the next calendar year. And then long-term assets are really like farmland or houses or major pieces of infrastructure, things that have a 40 year plus lifespan. Liabilities sort of mimic those. So if you remember back to that initial format that I showed you, if you're going to put an asset on one side, like cash or checking in that short term, then you would want things like credit card debt or accounts payable or a line of credit would be on the corresponding location on that balance sheet in the short term area. And the intermediate things would be like equipment or operating loans. So if you bought a tractor, the remaining principal on that tractor loan would go in that intermediate area. There is, there are some accounting rules around putting portions of loan payments in the short term and intermediate areas of the balance sheet. But I think for most folks, as long as you're making sure that you have everything in there in terms of what your liabilities are and what your assets are, where they are within that balance sheet is not going to impact your net worth down at the bottom. And so it's just important to really get them in first. And then if you build your financial knowledge, you can start to separate them out into the areas where they should really be by accounting principles. All right, so that's the balance sheet. Just a couple more notes on that. The balance sheet is really, I think folks tend to skip it more than the other two financial statements. And the reason that the balance sheet is really important is that if you have significant changes in either those assets or liabilities year over year, that can really mask things that are going on in the rest of the business during the year. And a good example of this would be if you had someone with, $50,000 in storage crops, and they did their balance sheet on January 1 of 2022, right? And then over the course of 2022, they sold that $50,000 in storage crops and recognized it as income. And we'll talk about that in the profit and loss. But they didn't grow and store $50,000 in storage crops for the next calendar year. But they would have this income from this year, but what they wouldn't have is that income in the next calendar year. And they wouldn't know that because they hadn't updated their balance sheet over here. So it's really important to understand year over year, and you do what's called accrual adjustments on the profit and loss statement, which allow you to see changes in your net worth to see if you are actually profitable or not. Because a lot of folks, especially when you're in a startup phase for a farm business, you may actually not be profitable in the profit and loss statement. And we'll talk about what that looks like, because you are paying down debt on infrastructure. And so you end up but you may be building equity on your balance sheet. So you may, like if you have, if you have a tractor payment that's say $6,000 a year, so you're actually building equity to the tune of $6,000 a year, but that debt service is coming out of the business, and you need to understand that it may look like you're losing money or you're not making as much money, but you're actually building your net worth as well in those assets. So that's how that process, that's how those two financial statements interact. So we're gonna go into the profit and loss. I will say again, if you have questions, put them in the chat. The profit and loss is also sometimes called the income statement. They're sort of used interchangeably. And this is the one that summarizes that activity that happens between, over the course of that fiscal year. And most folks have a January 1 to January 1 fiscal year. Some farm businesses actually elect to shift their business year based on the type of crop they're growing. Like I work with an orchard that has a July 1 to July 1 fiscal year because they have no inventory on July 1st. So it's much easier for them to have that be their fiscal year than have to go through and count bins of apples on January 1st if that was their fiscal year. So, and you can choose that, but most folks just go with the January 1 to January 1. So ideally, the income statement is separated out into variable and fixed expenses. So variable expenses would be things that fluctuate with the level of production on the farm or within the business. So variable expenses would be things like, especially paid hourly labor, seeds, amendments, things like that, feed cost if it's livestock. And the reason we separate those out is that that allows us to do some analysis on the back end of the profit and loss. And then the fixed costs are often also called like the overhead of the business. The fixed costs would be things like taxes and insurance, utilities, although utilities, it really depends on the business. If you have something like we have folks that are now going into the adult use cannabis business here, and they're doing these indoor grows, and I think their highest expense is going to be electrical costs, like their utility costs, and that's very much a variable cost tied to the level of production. Whereas on a normal farm, like a vegetable farm, something like a walk-in cooler would be more of a fixed cost. You're going to run that cooler year round, and whether it's full or not, and so that would be just part of the overhead of the farm. And then we really encourage folks to do more of a full accounting of what's happening, not just in the farm business, but in their lives as well. So I talked about this a little bit earlier, where you have your income and expense, and then you have sort of non-farm income and non-farm expense below that, which allows you to see the full picture of what the financials look like and how they impact the person and not just the farm. So this is sort of a visual representation of what a profit and loss is. It's like income, then you subtract those expenses, the variable and the fixed expenses. You come out with a net cash income or net farm income from operation. Then we work through adjustments, and those adjustments would be things like the difference in short-term assets based on the balance sheet. So if we took that, the stored crops and either added or subtracted that 50,000 based on where the timing of it in those balance sheets, that would be an adjustment. For tax purposes, you add in depreciation of assets. I really encourage folks to think about depreciation as a real thing So, you know, the world is sort of degrading everything around us and the environment. And so, you know, you have to replace that, whatever that asset is. And so something like a mower or a piece of equipment, maybe a rototiller for doing vegetable production, you would want to assign a level of depreciation that reflects that you're probably going to have to replace that tiller after 10 years. So if it costs you $5,000, you know, putting $500 a year into your calculation around what depreciation looks like, that is a reflection of the need to replace that piece of equipment. Oftentimes that's also reflected in debt, because people will buy those things on credit, and so those debts reflect the depreciation and the need to replace that thing. So the things that don't live in the profit and loss, for the most part, are debt service. So if you're doing it correctly, you separate out the interest and put it up in the expenses portion of the profit and loss, and then the principal ends up on the balance sheet, and the interest is actually the cost that you have to access that capital. So that's what you're paying the bank to be able to use their money. And then the other one is usually, you know, the income that you get from the work that you do. So unless your business is structured where you're actually taking payroll out of the business, then you know, whatever that net income line item is, that is your income. And there are reasons to structure it in that way, but you need to be above a certain scale to sort of work with a tax accountant to do that. But that's usually later on in the business development. All right. So just to reiterate with the chart of accounts and sort of thinking about the profit and loss, is that really having a relatively simple chart of accounts is something that I strive for with folks. You know, I think having that $500 threshold per income or expense account is a good idea. I'm just going to pull up here. Yeah. So, and those, you know, I think that having the chart of accounts where the accounts reflect the business activities are really important. So a lot of times I'll start working with folks and they'll have all of their income lumped in one area on their chart of accounts, which is, you know, they'll just say vegetable income. And what I like to have folks do is really try to align those accounts with the actual activities of the business. And so those would be things like thinking about the market, like the specific market for that business. So we either, and this is sort of part of the process of developing out the financial system for the business, is that you really want to align the income or expense accounts with the specific areas of the business that make sense. So a lot of folks, if they just lump it all into one veggie income, then we end up with no way to do that back end analysis for the vegetables. And what we may shift to is either aligning them with specific markets. So a lot of folks will have like a farmer's market, a wholesale market, and maybe a CSA. And so what we would do is try to get them to put their income into those three buckets, so then we can understand they may also align their expenses with those three buckets as well. Farms that are diversified, I've worked with farms that have like a vegetable farm, livestock, and we may even separate out the livestock, and then an orchard. And so what we would want to do is separate out the income into those 3 areas and then the expenses into those 3 areas. So we could do the analysis around, and that's where we get into enterprise analysis around if it's a beef enterprise, we want to know how much money they're making on beef, and then what the cost of those animals is, so that we can determine whether it's a profitable enterprise or not. To go back, you really want to have consistent classification of the expenses within each account. So I do a lot of business transfers or sales at this point. We have a number of farms in the state that are in the process of, they have aging farm owners and young farmers want to take over those businesses. To do that process, I have to take their financials and standardize their profit and loss over 3 to 5 years. And most times people classify things in different areas based on each year. So, fuel may show up in one area on one year, and then they use a credit card for it on the other year and didn't classify it right, and it ends up in vehicle expense. And that can be really difficult if you want to do back-end analysis, or if you just even want to have clarity around where your spending is happening. So that's what I mean by consistent classification into those different chart of accounts. I would say this, an indication of potential challenges within the profit and loss is if you have negative numbers in any of your income or expense. Like if it's structured properly, everything is conveyed as a positive number, both in the income and expense areas, and then the income is subtracted from the expenses. If you have a negative number, it actually means you're subtracting a negative, which is adding a positive. So from an accounting perspective, that just doesn't make sense. And that usually happens in QuickBooks, where someone doesn't know where they need to put something and they put it in there, and it ends up being like, I had one of these just last week where it was, they had $65,000 in cropping expense, and it turned out that was actually income from the crops that they had sold, and it was miscategorized, and the farmer didn't know where to put it. And then you really want to make sure it's just organized and makes sense for your farm business. So, in the resource links that I'm going to give you, you can look at the structure of the financials. We actually have a sample farm business plan with financials on our website that's based on a small scale diversified farm. And I feel like those financials in that sample business plan are really well suited to that business. They have the right chart of account. They're at the right scale. They are very, they work for that business. So, and then the other one is just like, if you have a tax accountant, you're probably experiencing the same issues that we are here, but tax accountants are hard to come by. Farm tax accountants are really hard to come by. And so having clarity about how your tax accountant is going to use your information and having a meeting with them preemptively, not on April 10th, but on October 15th of the year prior to filing those taxes is great, because if you meet with them in the fall, you can get feedback from them about how you need to, if you need to spend money, if you need to do some refinement to your finances before you file your taxes. All right, we're going to talk about the cash flow. So this is the cash flow. This is not actually a great example of a cash flow because it does not have the cash on hand line at the bottom of the cash flow. And so basically, but what it does do is mimic the profit and loss. So if you look over, this is actually a relatively simple cash flow in that it was developed for a small scale dairy. And so it has cash coming in. The income is entirely under the Agrimark income portion there. And then the expenses are also relatively straightforward. I like this one. If you look down the total column on the far end, you end up with, you know, the majority of those expenses are, or expense areas are above $500. There's a couple in there, like these folks didn't spend a lot on office supplies, or I think the other one is dairy supplies. But they have barn supplies at 11,000. So that dairy supplies could just be added into the barn supplies line item. And so what you see here is, you know, it's basically done by month, and I use the same chart of accounts as the profit and loss. So I actually just take the profit and loss out of QuickBooks. If folks are in QuickBooks, that's what this one was developed out of. And then I just expand that out to a full calendar year, or sometimes 2, 3, even 4 calendar years, and create a cash flow that mimics this format. So the reason that we do this, or that we do the cash flow, is we really want to understand the cash position of the business over time. And so actually, to go back to this one, the mentor that I was talking about, who taught me about the financial statements, he sort of said to look at it almost as a graph, and that this one is not a great representation because it doesn't go, dairies are actually relatively static in terms of their income and expense by month. But what it does, so like a vegetable farm, you know, you would see really significant expenses and very little income in the earliest months of the year. And what you would probably see is a cumulative cash deficit. Some of the farms that I work with, depending on their scale, can run up to $500,000 in cash deficit in the early months of the year, because they have a really significant labor bill. All of their expenses are clustered in that portion of the year. They need seeds, they need amendment, they need fuel. And those crops are not going to start to come out of the field until June or July. And it's the same thing with small farms. Like if you are, you know, if you're going to sell $30,000 worth of vegetables in a calendar year, you may spend $5,000, $10,000 from January until June before you start harvesting crops that you would sell at a farmer's market or to a wholesale customer. And so the reason we do the cash flow is to understand that cumulative net deficit at whatever point in the year it is for that farm. And then that's a place for us where we understand that we either have to access capital, like we have to, if we have savings on hand, we would use that, or we need to go to a banker and ask for a line of credit or an operating loan. I have definitely seen folks manage this on credit cards. I would not advise that. So there are definitely better ways to, you know, access capital than credit cards, and credit cards can be a really slippery slope because of their cost of capital. If you're paying 15+% to access that capital on a monthly basis, you are really, you better be making a lot of money on your business, or you're going to be in trouble really quickly. And so they're done by month. Sometimes I just do projections by year with farmers. So we'll do an annual cash flow projection. That's just sort of like that total column that was on the prior page. And I'll do that with folks who, oftentimes we'll do that with folks who are just starting out and don't know their monthly income and expenses. And so it's just, you know, and I'll also do that with folks who have a capital reserve, so they're not going to need to access capital or borrow to cover any deficit. And yeah, so that the cash flow is used for that. I will say there's some notes on the cash flow, like the timing of income and expenses within the cash flow is really important. So, you know, with that dairy farm in in particular, those folks, they produce milk and then they didn't receive the income for a month after they produced that milk. And so when I talk about timing, if you're selling, say, to a wholesale account, if you sell vegetables to a wholesale account and their terms are net 30, that means that you probably will not see that check for 30 days, right? So you need to be able to bridge the gap between them receiving the crop and you receiving the cash. And I would say the same about expenses, right? Is really understanding when the cash flow is meant to convey when those expenses actually hit. So when you are projecting out for the next calendar year, you want to try to be really conscious of, like, if you're going to buy fertilizer or compost in March, you want to make sure that that's really when that's going to happen, because it may be the difference between you having that money in your bank account to pay for that or not. And so, like, bigger businesses all sort of manage their cash flow based on this concept. Like, and I do know some of the producers I work with that sell into larger wholesale accounts, like some of the bigger grocery chains up and down the Northeast Seaboard, or someone like Whole Foods, they may actually not end up with the income from that product for 60 to 90 days after they've sold it, which is really significant. And it's the way that, you know, like those grocery chains, they're actually sort of borrowing that money from the producer. It's definitely not a great way to do business. But from a producer's perspective, you just have to know when the timing of that is going to come. I prefer people do cash flows in sort of a quick and dirty way, as opposed to adhering to accounting principles, like separating out principal and interest above and below the line. I also like to have folks do that same format where they put the income and expense for the business above, and then have personal income and expense down below. And I think that those are, that's really important in understanding not only the business cash flow, but your personal cash flow. So if you don't have that, you may run a net deficit on the business, but you may be able to cover that through, say, off-farm income or some other income stream, or you may have some sort of debt service that makes it so you're not profitable throughout the entire year, which is another challenge. And then the big thing about cash flows is that you are making sure that there's everything in there. So I can't reinforce enough, like, how many times I've gone back with folks and gone through it line by line and said, wait, is that? And they're like, oh, wait, I forgot about that. Yeah, we're definitely going to have that expense in that month. And so that's really challenging. So you just want to try to have as clear a picture as possible. The cash flow is probably the most challenging document to work through. If you look at this format, it takes time to work through the income and expense in each of these categories. I oftentimes will have folks do it based on the last calendar year and then go through, and if they don't have a sense, then they need to make an educated guess. And we have a saying in the farm business planner community where you move, it's like a process of moving through based on the development of your business, that you start out with what we call WAGs, which are wild ass guesses, and then we move to what we call EWAGs, which are educated wild ass guesses, and then eventually you move to a point where you get really good at it. And like developing a cash flow is like riding a bike. If you the more time you spend doing it, the better off you will be. And you know, I have worked with, like, I have one farm in particular that I worked with, helped them buy their first farm here in the state. They were vegetable growers. They are vegetable growers. They started out, I think the first year they did maybe $50,000 or $60,000 in veggie income. And I worked with that. It's a couple, the woman does all the finances and sort of manages the business, and the man is the grower. And I worked with them and taught her how to do a cash flow that first year. And every year she comes back to me now, and we just do a quick financial update. And they now own 2 farms. They do, and a retail market, and they do probably a couple million in business at least. And she is now at the point where she can get her cash flow within, I want to say probably $2 million in sales, 20,000 over or under on income and expense in that document, which is amazing. So, and that should be your goal, is to really understand the flow of money in and out of your business, because it makes you a better business person. If you're doing this cash flow correctly, you develop the cash flow in October or November of the calendar year before. You align it with your production. So if you have a crop plan, if you're a vegetable farm or a livestock farm, you align it with your production and sales goals. And then if you update your bookkeeping system monthly, you can actually do what's called a budget to actual. So you take that cash flow and you plug the actual numbers in next to it. And that's what allows you to actually make the refinement to your business as you're moving forward. So if you said that you're like the past few years, especially with COVID, fuel costs for some farms went up, it more than doubled, right? And so if fuel was one of your major expenses, for those farmers, if that doubled, they either had to decrease fuel usage or increase the income from their product by increasing prices or whatever it was to reflect that. And the only way to really know that in real time is to have your bookkeeping up to date and have a cash flow that you can say, oh, well, I thought fuel was going to cost me $30,000 that month, and it actually cost me $50,000. So I either have to make more money for my product up here or cut fuel costs in some way down here. All right, so there's whenever I teach folks about financials, I try to convey a couple major core concepts relating to the financials piece, right? And the first of these is that I work with a lot of farms every year. I work with about anywhere between 30 and 40 farms, and I do, at this point, I'm working with a lot of farms that are transitioning to the next generation. So I get to work with a lot of exiting farmers. And what I like, the core concept that I like to convey is that you really want to strive for building your business management skills. You want to strive for being profitable in your farm business. But what you also want to do is long-term, really building equity and limiting debt, like focusing on not just the cash coming out of the farm business, but if you have debt related to the farm, reducing that debt load, and then building equity over time. And I'm going to put up this next slide, sort of conveys these are the numbers from 2 farms that I worked with a few years ago. If they're both operations that have a grass-based dairy component, they have other enterprises like some livestock, like meat sales, and they're both really values-based farms. They've been in the business for the same amount of time. They have roughly the same land base. Like if we were to look and fly over their farm with our camera and see their assets and liabilities, this is what their balance sheets look like. And from the exterior, you would not know the difference. But what I know, because I've worked with both of them, is that this is what their balance sheets look like. And if you look at balance sheet number 1, that farm has, they have about the same amount of assets, right? They have the same amount of cows, the same amount of activity going on. They sell into different markets, but the one with the like higher level liabilities actually is not, they're selling into what would be perceived as a higher margin market. So they're selling direct to consumer, and this one is selling into commodity dairy. But the liabilities on the grass farm too, you know, like if you look at the difference in the liabilities and the net worth here, what you end up with is a picture that's really different in terms of they're both trying to convey the farm on to the next generation of their family. And farm number one is, you know, they're having a really hard time because that annual income is not from farming. That annual income is from off-farm activity. And on grass farm number two, that annual income is from the farm itself. So these two have they have really different potential paths forward in terms of the way that they could convey their farm. And they've taken really, really different strategies. Like grass farm one, they spent a lot of time sort of chasing opportunities or not necessarily being focused on the fundamentals of their business. And grass farm two, they just worked really hard, were frugal and paid down debt, and actually have savings. They have quite a significant amount of savings for retirement. So it's like just very different management styles. All right. And then, so when we work with farmers, we also encourage them to have an exit plan. And this goes back to that initial portion of thinking about the financials and thinking about the financial goals. And I work with folks who, you know, if you're starting up a farm enterprise, it's really hard to look and see what the end looks like, but it is not, it's not that you really want to try and think about what your long-term goal is for that farm. If you're on leased land, you know, do you have security in that lease to be able to make money out of that farm over time? And if, you know, we at the Intervale here, we've had 3 farms transition in the last 10 years or transfer to new owners. And that's been a really difficult process because those farmers didn't really think about how they would convey those businesses or how they would make money once they had sold their farm business. So I just encourage folks to try to like think a little bit farther out and think about what the next step is. So I think that I have some resources here that I'll actually just, I think I can copy them and drop them in the chat. Ooh, or maybe not. And then I'm going to go through some of these questions in here. I don't have more PowerPoint, and I can also pull up financials if folks have specific things they want to drop in the chat. And we lost a lot of people in that. Farm financials are boring. So folks, a couple of folks had questions around running a nonprofit or farm financials for a nonprofit. I do work with a number of farms that have a nonprofit component. I will say that nonprofits, you know, a nonprofit is a misnomer because it's nonprofits still need to make a profit to stay in business. How they make that profit is different. So what you're actually running is a not-for-profit. And you know, being a nonprofit allows you to access grant funding. It adds a level of complexity, both in terms of the governance that you need a governing board as a structure, and then also in terms of the finances of the business. So you do need to have, you know, much more robust bookkeeping systems in place to operate as a nonprofit. And then you, in theory, by IRS rules, you should have a governing board, and that can create other challenges. I also have, you know, I work for a nonprofit now. I've worked for nonprofits almost all my life, and it can be challenging to balance the farm activities with the nonprofit activities. A lot of times balancing that, balancing sort of the difference between the production piece and say like an education component or a food access component can really put or create some conflict between the two pieces of the enterprise. I actually managed the farm enterprise at a large educational nonprofit. And there was always this challenge between trying to identify the farm's role in either, you know, generating a profit or supporting the educational enterprise. And then also just separating the two out. I work with a educational nonprofit up here that manages essentially a for-profit farm within the nonprofit. And then the profit is actually the food generated for food access programs, like for food shelves and things like that. So another question was like methods of building collateral while diversifying operations and income. You know, collateral is built generally in infrastructure or equipment. So the easiest way to build collateral is in buying land, but that is not in any way easy at this point. But you can build collateral in things like equipment or, you know, if you're doing a low collateral farm on leased land, like the farmers that we have here at the Intervale, a lot of them will buy, you know, they really strive to generate profit out of their operations here. And then they buy a house in Burlington, which actually appreciates at a much greater rate than a farm property would. So they're actually better off in that investment than investing in farmland and buying a farm. But you can build collateral in things like, you know, equipment or vehicles, things like that. But if you're not building collateral, you really should be generating income through the business, cash income that you can put into other areas, like either into retirement or savings or something like that. There's one here around budgeting and payroll systems. So budgeting, you know, I would encourage folks to budget within the financial spreadsheets. And I can, you know, the link that I'll share has those. It really can be as simple, like if you're just starting up, it can just be as simple as doing a handwritten budget that has the income, expenses, and the net. But I find it's easiest to use those spreadsheets to really start to refine what is a good place. So we talked about financials. Where do we find benchmarks? Benchmarks can be a little challenging. I will share a link. I'll have Eric and Tess send these things out, but benchmarks, especially for like small farms, are relatively hard to come by. We do have our Organic Farming Association here in Vermont generated these, what I consider to be pretty decent benchmarks around organic vegetable production that actually provide benchmarks for income and expense for specific crops, as well as they have a whole farm benchmark, which is a great sort of starting point for metrics for a small scale organic vegetable operation. There is a challenge in generating benchmarks with small farms because a lot of their operations are just not consistent. Whereas like dairy farms are a good example up here where they're really, you know, they're pretty similar in terms of the production and financial records, which make generating benchmarks relatively easy. Yeah, what kind of records to keep for taxes? So we talked about that. There is a farmer's tax guide that is available through the IRS. If you can just Google the farmer's tax guide. It is pretty hefty. It's like 300 or 400 pages. But what I would recommend is to start with the Schedule F and use that as the starting point for the different accounts that you need to be aligning your financials with. And then if you can find someone who is a good tax accountant who is familiar with farms, they can definitely help you there as well. What I will say about taxes, and this is one of the questions around here, and thinking about taxes, is if you're in a startup mode, to purchase land, the Farm Service Agency, which is the primary agriculture lender, there's the Schedule F. Thank you, Tess. The FSA requires 3 years of Schedule F to be able to access capital for a farm purchase. And while it's not frequent that folks are really looking at buying a farm without having any farm experience, it can be a barrier. And so what I encourage folks to do is really, even if it's just on a small level, if you don't consider that your income or expenses are of the level that you need to file taxes, that you do it anyway if you have the intention of growing your farm to the point where it supports a farm purchase. So yeah, it's, you can access FSA programs, like lending programs. And I often encourage folks, if you think you're going to grow your business, if you think you're going to purchase a farm at any point, if you think you're going to make a major infrastructure improvement or something like that, go in and meet with a lender early, and really understand your numbers. So work through the financial package and develop a business plan if you can, and then develop the relationship with the lender as early as possible. So I often encourage folks to go in and take out an operating loan right when they start or in the first few years of business, even if they don't necessarily need the capital. If their intention is to buy a piece of land or eventually grow to a level where they have to buy a structure or whatever that major capital ask is, if they've taken a loan with that loan officer and developed a relationship, that is the foundation for that loan officer's understanding of that farmer and their business. So if they're familiar with you and your business, and you walk in and say, I need to borrow $300,000 to buy this property over here because I want to move my business over there, they're much more likely to give it to you than if you already have been making payments on a tractor or some piece of equipment for the last 3 years. Then if you go in and you're like, I need $300,000 to buy that over there, and they're like, who are you? I've never met you before. I don't know you. FSA is one option. They do have, and I think that this is a somewhat universal problem, is that they're having a hard time staffing their positions, and then there has been historically some challenges around like structural or institutional sexism or racism within FSA, and so accessing capital for women or minority farmers, like BIPOC farmers, can be really challenging. They also have acknowledged that, and especially in some, depending on the state office, in the last few years, and made programs that provide much more favorable access to capital for those communities in the last few years. So I encourage folks to really reach out to FSA. If you think you're going to need capital, start the conversation really early, because you probably will have to do some education around your business model as well. That's another piece. Like, they don't necessarily understand things that are not commodity agriculture. But in our state, we've had, real success over the last, I want to say 5 or 6 years, educating FSA loan officers around the potential profitability of diversified farms because dairy farms are not necessarily making money anymore. Someone put in here, I'd like or would appreciate a discussion of a farm assessment. How does it work really? Also notes on IRS considerations. I am assuming that by farm assessment, we're talking about a farm appraisal here. And so the farm appraisal is a process where the farm is, it's an independent appraiser will come and do a process of looking at the farm and assigning a value to it, or a farm property. And it's very similar to a residential or a home appraisal, where they come in, they look at what they call the subject property, and then they do what's called, they do two things. They assign a highest and best use, and then they do a comp analysis or a comparative property analysis. And through that process, they look at the values of recently sold properties that are relatively comparable to the subject property or the farm in question. And then they do a series of calculations to equalize the difference between the subject property and the property that folks are the comparative or comparable properties. So like if this one had, say, 50 acres of tillable land and this one had 70 acres of tillable land, this one, they would do an equalization to say that the value of that additional 20 acres needs to be subtracted from the comparable one to arrive at a value for this farm here. The reason that appraisals are important is that if you are going to buy a farm and you're going to do it with a loan, you need to have, the lender will only consider the value of the appraised value of the farm. And oftentimes farms are marketed well above appraised value. So for a farm purchase to happen, either the seller has to agree to the appraised upon price, or you have to come up with the cash to make up the difference between the mortgage and the appraisal value. I just was on one of these yesterday, and the seller, in this case, the farmer was, this farm is going to go through the conservation process, which will then eliminate the development value of that farm. But the seller was looking at it and saying, well, I think my farm is worth, more than the appraisal came back at. And what we had to do was really I talked through it with the buyer and the seller and said, the appraisal is what it is. And it's the independent appraiser's opinion of that value of that farm. And the seller was like, well, I want to see my farm stay in farming, so I'm willing to sell it at what I perceive to be a reduced value. It's a real challenge right now with land values appreciating the way they are. Like, I think everywhere in the country, development pressure and land speculation have led to a real challenge for folks who hope to generate their livelihood from agricultural land. Keeping going down the list here. So this one says, interested in meeting the record and IRS filing requirements and the records that are accepted by most lenders. And the format that I talked about at with the balance sheet, profit and loss, and cash flow or projections that's the format that any lender is going to want to see your documents in. They may provide you with a loan application, which you have to sort of convert those numbers over to their specific documents, but that is the generally accepted format that they're looking for financials in. And with IRS, they're really just looking for the profit and loss, and they will be looking for an asset list that's similar to the balance sheet. if you're starting from zero, how much effort is sensible to recreate several missing previous years without any filing so far? And due to low-income IRS guidelines, which do not require filing. This one really comes back to, do you need those records to be able to access capital in the future? A lot of times, if people have not done a great job of record keeping prior to working with us, we'll often tell them, let's just set a date and start then, and have you work through the financials on, we'll start January 1, here's your new chart of accounts. If you're going to QuickBooks, that's the right time to do it. And let's just start fresh, right? We'll make sure that you get your taxes done for the prior years if it makes sense to you. But having those Schedule Fs on file, if you are going to access capital, is essential. All right. So I think I'm just going through these. Yeah, I think that is what I have in terms of the questions. And the one other thing that I did want to do is pull up just some sample financials for you to look at. And I'll just share like a real simplified set of financials so that you can understand, well, a couple different sets of financials so you can understand what they should look like, right? So I just have to get these up. And I apologize, I had to switch venues and don't have my second screen here. So this is just going to be a really simplified profit and loss. It's a great example of someone who would be like sort of in a startup. If my computer will cooperate. It's taking its time. All right. And okay, I'm going to share it now. So this is a really like simplified profit and loss. What you'll see here is, this one is broken up by different market channels, which is really nice. They actually had things allocated out in a cost of goods sold, which generally, if you're just producing commodity crops like vegetables or livestock or something like that, I don't have a cost of goods sold line item. Where this becomes important is if you're doing value added production or you're adding in like products purchased for resale, which they were doing here. So this is all stuff that they bought in and then resold in their market. So you see they're making about $15,000 a year, and then they just have this really simplified expense accounts here, and they, it's like you can see that they only have about 3,000 into the crop production, which is really nice. Not a lot of equipment, and they were taking home almost $10,000 a year out of their vegetable operation. So that's, for these folks, I did help them eventually buy a farm property, and they grew to actually a couple $100,000 in vegetable sales. But for them, this was the starting place. This was on like around a half acre of leased land, and the grower was actually managing another half acre for an educational program that was a nonprofit. And so it worked really well for them. So that's one really simplified financial. And then I'm going to pull up another one that's a little bit more complicated. But it's, an indication of, this was actually a relatively challenging farm. We'll do the projections first. And I don't know if I can get this a little bit more. So these folks, this, we'll start up at the top, and we have income. They have these different, so theirs is also separated by market channel, and they have, they had some grant income PPP loans, stuff like that. And then you can see where we actually had the projections and then the actuals right next to it. And if we can get rid of these right here and just look at, so for 2021, we had, you know, this farmer was actually pretty close on the projections, but definitely missed on some income. Their farm stand numbers were way down. And so they adjusted that for 2022 projections, about 125,000 in income, real diversified. Some of these, you know, this chart of accounts, like having a $33 Etsy expense in here doesn't really help our analysis at all. And the feed, combined all feed, is a challenge when you're trying to figure out if your chickens or your sheep or your beef are making you money. And then we get down to the bottom, and they had projected making 35,000 and they actually lost 2,000. So, and labor is not factored into this one. And they did have some off-farm income. One of them worked off-farm, and they had a bunch of grant income in that calendar year, but that's not going to happen in the next calendar year. And so they actually had a net negative income projected for that year, and they actually made money. So that's just sort of an example of a real life farm. This one, you know, their balance sheet, we just have, yeah. And this is another great sort of example of some of the work that we would do in the planning, just looking at different, you know, this, we were talking about, they had to raise their prices because they didn't raise their prices during COVID, and they needed to think about the way to make more money is to either raise your prices or lower your expenses. And so they actually went through and looked at what it would cost to raise them 10%, 15%, 20%, or 25%, and then decided to base their price on that analysis. And some of them, they actually went over 25%. Some, they didn't go up really at all. And what that did was allow to move those financials into a different, like into their projections, to be able to understand how they were going to make money over time. All right, I'm going to unshare. Yes, did I not share that? Let me go back to that one again. I can't see the chat and talk at and share the Excel at the same time. Sorry, no two screens. I will go back to that one and we'll take one more look at it. Hold on a second. All right. And we're down to Kay. Kay, thanks for hanging out. Let's see if I can get this to flow. There we go. All right. In terms of projections, there we go. That's much better. With this one, so this is what I was talking about in terms of market channels. And then these were the actuals for the year. These are the projections. And so this is where, when we talk about doing projections and then looking, if we had done this on a monthly basis, we would have known that the farm stand was off by almost $14,000 that year. And so we would need to pivot. Same thing with the eggs. And, you know, that's like, this is pretty significantly off when you look at it. It's almost 20% lower in terms of the income. And then if we look down below here, they're also 10% over in expenses. So that would be the difference of essentially a 30% difference in the net income, which is really significant when you think about it, or not a 30% difference. It's the difference between, them being viable and not being viable. So in this case, they did have some stuff happen off farm, which allowed them to make up that difference, but that's probably not going to happen in the future. They had some grant income that year that was like PPP loans and things like that allow them to make up a shortfall. But what we're looking at in future years, if they don't hit their farm numbers in 2022 and 2023, then they're running a deficit in terms of the debt service and family living that they have to cover, which is down here. So that's about $30,000 a year, and they have $21,000 coming in off-farm income. And so they have to make money on that farm to be able to live. And in this case, historically, they have not hit their projections on the farm. So let me just see. All right, thank you, Kay. Yeah, so I'm going to wrap up there. I think that is about it. I will share resources. I'll send them along to Eric and Tess, and they can send them out to other folks. And
great, thanks so much, Sam. I was actually just going to ask. I know you shared the Richard Wiswall book, and the farm benchmarking. I wanted to follow up with that too. And I was wondering if you had any, like these examples that you shared were really great. And I'm wondering if you have any like recommended like templates that people can kind of get started with.
We have all that on our resource page. So I'll share that link. We have sample financial workbooks on the Intervale's resource page. And we also have the sample business plan and financials that align with that. So you can actually see like, oh, this is what that plan was based on a real farm property and like a hypothetical diversified farm couple that it really, I think it does a nice job of sort of conveying the story that would be, that's pretty typical. I would say the financials are like a little rosier than I would like them to be. They're not, they don't like, that the ones that I just shared, like that farm, that's their reality is pretty intense. Like farming can be challenging. And so I think that, but those sample financials, that's a great place to start. Richard's book is a wonderful place to start. Like I encourage anybody who's going to farm to get that book, read it. And then Richard actually does this like cost of production analysis for vegetables, which is super intense. I don't know anybody, like I've worked through it with folks. No one likes to do it. His method is like, he does cost of production on his 10 top selling crops per year. And then any of those that are not profitable, he just would knock off the list on his spreadsheet. And he's down to like one crop and selling bedding plants now, but that's because he's basically retired. Mm-hmm. But he goes through, and it's like, I mean, it's a really complex spreadsheet. It was the basis for the cost of production analysis that NOFA Vermont did, the benchmark study, which is really cool. And they put it together in a format that is really easy for folks to read and understand. It's these little brochures that break it down into like, this is what, your labor number should be for carrots if you're doing carrots. And this is, ideally, this is the price range we saw for what people were charging, and then this is how much they made per pound for tomatoes. So I can send those along. I'm trying to think. Yeah, but our resource page has a lot on it. There's the sample business plan. There's a resource flow chart for purchasing a property that, while it's sort of Vermont specific, the process is the same. And then we also have like, we have a resource guide for interacting with lenders. Once again, it's the same. It's specific to Vermont, but it has lessons that can be applied across regions. So yeah, there you go. So Eric put them in the chat, or you did. You got it here on top of it. Okay.
I'll send them an email too.
Yeah, if you could send out an
any
email,
other resources.
I'll send you that benchmark, the NOFA benchmark link.
Perfect.
All right.
Great. Thanks so much, Sam. This was
Sam, this was incredible information. Thank you.
Yeah, cool. Thank you, Kay, for sticking it out. You're going to be the one.
Thank you, Kay.
All right.
Everybody have a great day.
Yeah. Take care.
Thanks. Take care.
Bye-bye.